Hello and welcome to this week's webinar with me, David Jones, and Aondo Markets. If you're watching the recorded version of this, it was held live on Wednesday, the 26th of April at 12:30 in the afternoon. So this is a webinar that we run every week on a Wednesday lunchtime. And there's a few bits to it. There's a look back at what's been driving markets over the last few days. The French election has been a big thing. We'll have a look at some of the effects on that. We've seen some drastic moves in currencies and stock markets, so we'll take a look at that. Also, we spend a bit of time talking about strategy. Today, we're going to talk about position sizing, how big to trade. You know, if your account is X thousand, X million pounds, how much should you be risking on any one trade? And I think it's a mistake that plenty of us make, and it really can sabotage your trading if you're trading at the wrong sort of size. So we'll talk about that as well when we talk about strategy. And as usual, we'll look ahead to what are the markets where there could be opportunities in the days ahead. After, I think, some of the drastic moves we've seen earlier this week, it has left plenty of markets in really interesting areas. The DAX, for example, the German DAX has pushed out to fresh all-time highs, finally cracking that 2015 high, so we'll take a look at that. But also in the US as well, US stock markets have rallied, but are still beneath the all-time highs. So if you fancy to short on US stock markets, it could be interesting up here. But we'll take a look at all of this as we're going through. I've just put the risk warning up there just to give everyone a chance to read it. So hopefully that's all done. And what we'll do now, we'll just flip over quickly just to have a look at some of the moves this week since Sunday night. So I'm using Aondo's trading platform, Trade Hub. The obvious one to focus on, what we're looking at here, is euro dollar. So if I just zoom in, here we go. So the euro ended last week around about the 107.20 mark. It had been trending higher anyway for much of the last couple of weeks, clawing back some of its recent losses. The move here, it didn't actually happen like this. The chart has drawn in a candle that just zooms up on Sunday night, but actually trade on Sunday night started up here. So we had a gap, and it was quite a significant gap. It was like a 150-point gap. So the market had closed at X on Friday and then started trading at X plus 150 on Sunday night when the Asian markets opened, and it was off the back of that French election result, the first round of the French presidential election. So we saw quite a bit of relief for the euro and stock markets on the result. And I did think when I was watching it on Sunday night, that really is overextended, that move. That does seem to be something of an overreaction, that we haven't had a political upset like the couple we've had over the last year, what with Brexit and Trump. So I thought, well, maybe it has been overdone. The market did give back about 80 points of those gains, but you see on euro dollar, it has continued to push higher yesterday. You know, it's pushed through that that Sunday night high. So it's there's definitely still the strength there yesterday, but we'll take a look at the euro in a bit more depth once we've talked about strategy. Just a quick look at the DAX. You know, we saw similar moves in stock markets this week on the back again of this election. You know, the DAX closed last week around about 12,080, 12,100, and it's currently trading about 350 points higher. So again, quite a lot of relief for stock markets, just a general sort of risk-on attitude off the back of that French presidential election. Before we start, so that's been the big driver. That has been, you know, this week's driver has been some ongoing momentum over the last couple of days, following on from those sort of drastic moves on Sunday night. But let's take a look at strategy first of all before we have a look at the markets in a bit more depth. So as usual, I'm going to employ my artistic side here, so you can see we're going to do a bit of scribbling, I think, on the charts. Let me just bring something up. Here we go. Right, let me just show you the screen. Show the screen here. Right, and let's talk about position sizing. Hopefully, can you just see that? Can someone just confirm that you've seen? I've just scribbled on a sheet there on the screen, just so I know that's working and you can all see at your end. Perfect. Position sizing is really important, and I think it's a mistake that many of us make. I know I made it for years in the beginning, and it's all about how much to risk on any one trading idea based on how much money you've got in your account. So to keep the numbers easy for me, let's assume you have got £5,000 in your trading account, and you decide to do a trade. So you buy, I don't know, euro against the dollar. So position sizing is all about, well, how much do I risk losing if the trade goes wrong? And the reality is, most people risk far too much. You know, I worked for spread betting companies on the other side for 10 years, 12 years. You know, and it's a common mistake people make is trading too big. I think one of the first, there are many golden rules of trading, but I think probably one of the most golden ones is do not bet thy whole wad. But the reality is that people do. You know, people take on far too much risk, whereas most sensible approaches to trading suggest you should risk losing only 1 to 3% of your account on any one trading idea. So what that means is, if we, again, let's stick with our £5,000 account. Let's assume that we're going to risk 2% on a trading idea. What that means is, if any trade goes wrong, it should only lose us 2% of our account, which in this example is 100 quid. So if we buy euro dollar and end up being wrong on the trade, then the trade shouldn't cost us more than 100 quid. Now, plenty of people are against this idea, and the reason they're against it, because it can make trading very boring, because you're not going to be trebling your account in a month if you're only risking 1 to 3% of your account on any one trade. But it does ensure your long-term sustainability. You know, if you're risking 10% in your account, you have 3 losing trades, which is on the trot, which is perfectly likely. You know, in any sort of trading strategy, you're going to have runs of losers. And if you're risking 10%, you know, you're down a third. Your £5,000 account will be down to what, £3,500. You need to get nearly a 50% return to get it back to where it was before. So in terms of volatility, I think it makes it very difficult, I think, to have a calm, disciplined, don't really care much attitude to individual trades if you're risking too much. But what it doesn't mean your stop loss should only be 1 to 3% away. So that your market analysis comes first. So let's pick up on a made-up market. So let's say we've seen a market that's done that, and it's traded. Let's say that level there is 100, and that level up there is 150, and the market comes down and does that. So we decide to buy. And let's say we're buying at 105. So we're buying in at 105. We know that 100 has been really good support, so we're going to place our stop loss below here. So our stop loss is going to go in at 95. So 95 stop loss, 105 entry, and let's say 150 target. So that looks like a reasonable trade. Our risk here is 10 points. So we've got 10 risk, and we've got 45 potential upside. That's a cracking trade. We've got 4.5 times our risk as a reward in this situation. And the position sizing bit comes in next. So this is the bit that decides, well, how big am I going to trade? Because you can see if I'm buying at 105, let's pretend this is a share. So I'm buying at 105 with a stop at 95. My stop is 10 points away. So I've got nearly a 10% stop loss in this case. But the 1 to 3% bit is how much of my cash do I risk on this trade. So I'm allowed to risk losing if I'm employing 2% risk management approach. So I'm risking 2% of my account on any one trade. I'm allowed to risk losing, in this case, with my £5,000 account, I'm allowed to risk losing 100 quid. So if I'm a buyer at 105 with a stop loss at 95, I've got a 10-point stop loss. So if I'm spread betting, then I can trade £10 per point. Okay, because if the trade goes wrong, barring any slippage, I'm only going to lose 100 quid on this trade, which is completely within my risk parameters. And it's one of these things, I think it's pretty simple. You know, but to decide right at the beginning how much of your pot are you going to risk losing on any one trade. But you would be, maybe you wouldn't be surprised, but most people don't do it. You know, most people have a somewhat swashbuckling approach, shall we say, to risk management. They'll have £5 in their account and think, well, I'll risk 500 quid or losing 500 quid to 1,000 quid on this trade. And I think that's a big contributory factor to why most people lose. They just trade far too big for the size of the account. So this way of doing it is pretty boring, but it does ensure that you stay in the game, and no one trade really matters. If you have a trading approach that trades, I don't know, once a day, once every couple of weeks, whatever it is, you're not taking on a ridiculous level of risk in every trade. You can have a much more, I think, calmer and disciplined approach to trading. So I think that's, it's quite well accepted logic when it comes to how to size your trades, but most people won't follow that. Let's look at the markets. Let's see where we can employ this sensible approach to risk management. Let's start off with the euro, because it did have such a big move the other night. What's that? Oh wait, there we go. On Sunday night. So let's flip this out a little bit. And I think it's interesting, the strength that we've seen in the euro, because that move on Sunday has taken it. Oh, so this is the DAX. What am I talking about? I thought that had gone a little bit too far. Euro dollar, here we go. So that strength on Sunday and the strength yesterday has pushed it back up to its best levels since November last year. So this is a bullish break. When we see markets break out through levels that have been a bit of a problem, it has been a bullish break. But as we've seen in the past, the euro, it doesn't move in a straight line. So even though we broke up through on this level here, the market did sell off again. So I'm just wondering, I'm quite bullish on the euro for the rest of the year, but I'm just wondering if in the short term maybe euro dollar has got a little bit overextended, a little bit ahead of itself based on what we've seen this week. And I think what maybe helps the argument for that is if we look at the hourly charts. If we look on the hourlies, and let's add one of the squiggly lines. So here we go. Let's add our RSI onto here. So for me, I'd be looking at possibly opportunities to go short the euro. Yes, it's had a run up, but I'm just wondering if maybe it's a little bit overextended. We've got the last time it made this high, we talked about this a few weeks ago. We do have divergence on the RSI. So when the market gapped higher on Sunday night, not surprisingly, the RSI went fairly heavily overbought. The market sold off a little bit and has pushed higher since, but you can see our RSI has made a lower high. So this is known as bearish divergence. So this is a suggestion that maybe some of that strength has run out of steam. The market has dropped about 50 or 60 points since we had this sort of second overbought signal. So you could say that maybe for now the move is done. But I think maybe the trade to watch is if the euro pushes back up again towards this 109.50 level and starts to show weakness, it could be a good opportunity to go short. But I still think from a daily point of view, if we look on the daily charts, still any weakness, maybe back to the April lows looks like a buying opportunity. But just maybe in the short term, maybe it has got a little bit ahead of itself. We'll come back to a couple of these other markets affected by Sunday night in a second. But one I was talking about last week that I did actually miss in the end, but has come back to it again, is the Australian dollar, US dollar. So I think it was exactly a week ago that we were trading just about where we are now. And my view back then was we'd had this downtrend in the Aussie dollar for the last couple of weeks of March and the first half of April. And it hit a level, once again we had this bullish divergence building up where the market had just about nudging a bit lower, but you can see the RSI had started making higher lows. So again, it's a suggestion that maybe down here, this weakness is running out of steam. The market then rallied pretty strongly off there, then came back down. This is where we were, I think, on the webinar last week, April the 19th, so a week ago. And once again, the buyers came back in and pushed the Aussie up about 80 to 100 points. The market's dropped down again. It's still weak at the moment. Looking at the current hourly candlestick, it's a market that is still weak. But I do wonder if we're going to see a similar thing happening again, where we have these old lows in around about the 74.80, 74.70, 74.80 area. Are they going to prop this market up and we're going to see it turn around? But from a risk versus reward point of view, it does look like an interesting trade down here, for a buyer, because when I saw it earlier this week up here, I thought, well, if it gets back down to 7,500, I want to be a buyer. At the moment, it's 74.87 to buy. So if I'm a buyer at 74.87, if I put a stop, I don't know, maybe 74.60, maybe a bit further out, I've got what 30 points of risk. But if the market sort of rotates its way back up to here again, I've got maybe 115 points of potential reward. So I think from a risk reward point of view on the hourly charts, the Aussie dollar is definitely an interesting one down here because this level has done such a good job of holding any weakness. So I think that's one that I'm going to be watching for the rest of the day and into tomorrow. And what I want to see really, I mean, at the moment, the current hourly candlestick we're in that started at 12 o'clock, you know, it's still weak. It's made a new low for the down move. So it's a market that is still weak. I'd maybe want to see that turn around. If we flip over to the 10 minutes charts, you know, you'll see it again. It's still, you know, it's still slipping a little bit lower. So I wouldn't necessarily be in a hurry to buy just yet. But if we can have, you know, at least an hour or a couple of hours of strength ahead of this old level, then I want to be a buyer. You know, if it suddenly goes sailing through, then all bullish bets are off. But I think Aussie dollar, US dollar, as it was last week, is an interesting one to keep an eye on down here. The other one, maybe for the more longer term traders who don't want to sit there watching it all day long, which is fair enough, is again, it's from the other side of the world, but it's New Zealand dollar, US dollar. This has been interesting. We started looking at this in the summer of last year when we had that great trend up for the first sort of 6 to 8 months of last year. It's been losing ground since then. You could argue it's been almost a little bit sideways for the last 6 months, but we're back to an area on New Zealand dollar, US dollar, where the buyers have come back in. So if we have a look at that sort of level there, what is it, 68.62, and we're currently trading at 68.90. So we're about 30 to 40 points above that level. This is another one. It's like a bigger picture view of that Aussie dollar chart. We're back to an area where the buyers, you know, have come back in since December. Whenever we've been around about the 6,900 area, the buyers have come back in. So again, we're still weak. You know, we're looking at a daily chart here. It's a market that's still weak. So again, probably the more cautious, the more sensible, patient approach is to wait for at least a day for the market to turn it round, just in case it goes sailing through this level. But I think it's an interesting one down here. We don't really have any divergence just yet on this subject of bullish divergence. We've got the market's gone oversold here. The RSI went just about oversold then, but the market was making a higher low anyway. What will be interesting is what the RSI does here. If the RSI makes a higher low, the market has pushed a little bit lower, so it could suggest that maybe that weakness is overdone. But I think New Zealand dollar is another, I think, an interesting one to watch down at these levels. Let's do one more currency, then we'll flip over to look at stock markets. Dollar yen. So dollar yen, always a volatile one. We had that fantastic rally in the autumn of last year where it went from 100 up to 118 by year end, and the story since then has been one of the dollar sliding, the dollar giving back some of those big gains against the yen. But we've seen a good bounce over the last couple of weeks from just ahead of 108 to just above 111 where we are now. And I just think, you know, for those of you who are maybe a bit bearish on dollar yen, I think again this could be an interesting one to watch in terms of the run getting maybe a little bit overextended. So if we were drawing our trend line in, it looks something like that. So we've got our downtrend that's been in place for that's all of this year. The market has rallied, so our expectation at the moment, based on this downtrend, would be for the market to run out of steam. And we've got some obvious reference points if we were thinking about placing stops. Let's just have a look at our hourly chart. Let's just flip this out a little bit. Here we go. So we do have some potential problem areas for this dollar yen rally. Let's just try and get in as much of the chart as I think is relevant. Okay, that'll do. So we have the old highs from end of March. So let's plonk our level on there. So what's that? Around about 112.20. There we go. Oh, hang on, I didn't do that very well. And then we have our old highs here around about 111.60. Oh, it's not drawing it for some reason. Let me just draw it. See, can I draw like a freehand line? Oh, horizontal high low. That's what I want, isn't it? I'm drawing the wrong line. No, I'm not. Oh, there we go. That's completely the wrong sort of line that I wanted. All right, let's get rid of that. Okay, but the level I'm looking at, 112.20 to 111.60. So we have this whole 60 band area just above where the price is trading now. So from sort of 30 to 90 points above where we are on dollar yen now, that's really proved a problem. So I think, again, this is going to be an interesting one to watch, because if this rally is going to run out of steam anywhere, you know, we're getting near to the zone where it is. So for me, it's still strong. You know, it's just this morning, just 7 o'clock this morning, it's made a new high for that rally that's been going on for about 8 to 9 days now. But if it starts to maybe run out of steam up here, maybe we get a bit of bearish divergence on the RSI, I think it looks like it could be a good opportunity to sell dollar yen short ahead of what have been big barriers in the past. Let's take a look at stock markets. The DAX finally, the German index, finally broke out to fresh all-time highs. We'd had that barrier for the DAX, even though, you know, the S&P, the Dow, the Nasdaq, the FTSE have all made fresh all-time highs this year. The DAX hasn't. We had these old highs left from April 2015, so from a couple of years ago, around about the 12,400 mark. And the DAX, I think thanks to the momentum off the back of the French election, broke through those levels this week for the first time. There we go, we can see it. We can see it there. So just yesterday, it set a fresh all-time high. Traditionally, you know, breaks like this are bullish. The problem always is, you know, do you buy the break straight away, or do you wait for a pullback to buy in? I think because the DAX is such a volatile market, based on the sort of moves we've been used to seeing on the DAX, it does look maybe a little bit overextended up here. So my approach, if I wanted to be a buyer of the DAX, would be to wait to see if we get at least some of the strength that we've seen this week. If we see some of those gains given back, it looks to be an opportunity to buy into this uptrend. But make no mistake, you know, that break that we've seen this week, that is a bullish one, and it does extend, you know, this trend that's been in place. Well, there's off the presidential election lows, extends that trend that's been in place, but maybe the more gradual trend here. The trend for the DAX is definitely up. You know, the break yesterday or this week to fresh all-time highs confirms the bullishness, and any weakness, you know, back towards, if we did slip back towards the 12,000 mark, does look like a buying opportunity. The US markets are maybe a bit more interesting, I think. So this is the Dow that we're looking at now. And I have been surprised by the strength this week. So when I saw these markets open on Sunday night, I've got a trade on the S&P at the moment, an options trade, which is basically for the S&P to move around a bit but not actually do too much over the next 3 weeks. So I was a bit surprised by the move on Sunday. I thought, well, maybe this is a bit overextended, but the strength has continued. But we have some really obvious levels to look at in US markets. So this is the Dow we're looking at now. So we've seen a market that's been strong. And let's, you know, go up to here, up to the old highs here from the beginning of March, just ahead of the 21,200 mark. You know, at the moment the Dow is trading around about 21,000, so we're just a couple of hundred points below it. So that's really the big level to watch, 21,200 on the Dow. You know, if we break out through there, and we've seen just how vicious these breaks can be, you know, again, since the Trump election, when the market breaks through previous highs, it's as if everybody who's short suddenly covers their shorts. People who want to buy pile in because they're afraid of missing out on the next sort of major lurch higher. So that has real momentum behind it. So I think it'd be interesting to see, first of all, can the Dow get back to those all-time highs, 21,200? And if it breaks, are we going to see people sort of strapping themselves in for the next rocket ride higher? And you'd think we'd have an answer on that in the next couple of days or so. But I think it's a really, really big level to watch. Of course, the flip side of that is, if you think we've seen the top in the Dow back in March, beginning of March, we've seen the top for some time, then this little pop higher that we've had this week has given a good opportunity to go short. Because if we're going to go short now, wherever the market is, 21,003 to sell is where it's currently trading in the pre-market trade. If we're going to go short here, we've got an obvious level to set our stop beyond, because if you think the high is in, then clearly the Dow shouldn't take out that earlier March all-time high. So I think it's a really big level to keep an eye on. Let's look at the S&P. I mean, it's a similar sort of pattern. I mean, I do prefer the S&P to the Dow because it's arguably the purer market, isn't it? Because it's 500 shares rather than just 30 for the Dow. So the big level in the S&P just above that 2400 mark. So we're currently trading 2386 on the S&P. So a really obvious level to watch there. If we flip it over to the hourlies, you will see there's the gap on Sunday night. So the S&P ended the week around about 2347. So the trade that I've got on is structured for the market. If the market's at 2350, sort of the third week of May, that's where I get my maximum profit. But I've got a bit of wiggle room either side. But you can see there's the gap, and the market had almost a bit of a pause on Monday, but yesterday has powered higher. So definitely momentum still for stock markets yesterday in the US following that gap higher. So it's going to be a really interesting one to watch. But I'd be quite happy if it decides to sell off a little bit and pulls back to this sort of zone. But even if it did that, it's still a buy. The trend for the S&P, if we forget about maybe some of the fun and games that we had on Sunday night, if I can actually manage to draw a line in this time, there we go. Our trend for the S&P and the Dow was up before the French election happened. It spent all of last week gradually making higher highs and higher lows, US stock markets, took off on Sunday night, bit overextended at the moment. That doesn't mean it's going to stop going up, of course, but if the market fell, if we pulled back to 2360, 2365, it looks like a buying opportunity into this trend. So I think for now, the pressure on US markets, US stock markets, is definitely still up, and the big level to watch are those all-time highs that the US markets hit at the beginning of March. Let's wrap things up today by looking at gold. Let's have a look at that, because I think this is still interesting. I mean, with the strength that we saw on Sunday, let's bring up gold. So the French elections, there was no real shock result for the French elections. Maybe the concern was that Marine Le Pen was going to have more of a showing, and we could see maybe the possibility of Frexit, as they call it. The French questioning their relationship with the EU. So there's a run. So people were relieved and a risk-on feeling after Sunday night. And when investors start taking risk on, we see the price of gold slip, and that's exactly what we've seen. We've seen the price of gold lose a bit of ground this week. I mean, not much, maybe about $10, $15, but it doesn't really change the big picture view for gold. The trend that's been chugging away this year is still going strong. We've broken out through the Feb highs, 1260. We had a little surge higher on the US military action in Syria from a couple of weeks ago. We've broken out through those highs as well. Gold is bullish. So for me, any weakness, any major weakness in the price of gold still looks to be a buying opportunity. We've got lots of support sort of down here, running at the 1235 area. So even if we were to lose another sort of $20, $25, it still looks like a buying opportunity. So I think for maybe the medium-term traders, that's the one with maybe one of the clearer trends, I think. And I'd fully expect the price of gold to continue to move higher this year. So there's lots to watch, really. I think the immediate one for me is the Aussie dollar trade, because just on the hourlies, we're back to, or in the 30-minute charts, we're back to a level that has propped the market up over the last couple of weeks. Let's see how it performs down here. On the euro, because the market has soared up so high, I'm just wondering, has it got a little bit overextended, even though the medium term's bullish? Has it got a bit overextended? But probably the one I'm going to watch the closest, because I've got a trade on, is going to be the US stock markets, the S&P and the Dow. These markets, they are positive, but there's those all-time highs from early March, so about 6 weeks ago. Can we crack those levels? I think there's plenty there to be keeping an eye on. We'll wrap things up there. We're bang on half an hour, I think, so we'll start wrapping things up. So as usual, if you have any questions, you can drop me an email. My email address, best email for me, is david@tradeafter.com. You can follow me on Twitter, where I'll try to tweet interesting chart levels and stuff like that. I do regular social trading webinars with Eondo about copying other traders, and you can see more details. I've done a blog on a real live account on www.tradeafter.com, so you can read a bit more there. But I hope you found it interesting. It's certainly been an interesting week, you know, with the surges that we've seen, and I think maybe the second half of the week is going to be the more interesting, to see if markets hang on to these gains or start to decide, well, actually, maybe Sunday night was an overreaction. So I think we're in for an interesting couple of days. We'll do it all again this time next week. Thanks for coming along today, and until then, I hope you have a good trading week.